Hi, this is Brent with Trade Therapy, and welcome to the Trading Couch. We are talking about SOFI Technologies. SOFI was part of our top-down analysis for Robinhood Markets. If you haven't checked out our Clarity Spotlight on Hood last week, you should. There's a coupon at the end of this video. It'll give you 50% off the next 6 months. We break down institutional positioning and strategy in trades every week. SOFI, it's a great example of how institutions execute their business plans, from how they generate capital to how they build positions, how they defend those positions, how they extend trends over time. We're going to walk through all of that using this clean weekly chart. It's got some labels on it. Don't worry about it. I'll walk you through it. But SOFI coming out of IPO shot up over 250% in just a few weeks. It was a great example of hype-driven buying that gave early investors the perfect exit at high prices. They then followed that up with a series of fakeouts to truly take advantage of the moment. The hype-driven retail buying frenzy provided institutions a great opportunity to generate capital. They then took a short position and moved price down into this downtrend. One last uptick here with a long upper wick left behind it, the highest volume in SOFI's history. This is one last chance to try to lure in retail investors. If you ever see price come down and lose all of its moving averages and test it from below on very high volume, and it does not retake those moving averages, that is a sign that it's time to get out. That is telling you that institutions just dumped the last part of their long position, and they're going to move price down into the range where they are interested in buying. So that's exactly what occurred. The institutions brought price down into this, what we call institutional buying range. This is a Wyckoff spring. Effectively, that's just a low that undercuts the previous lows. You can see a lot of volatility during this period. That's how institutions raise capital. They lure retail investors in only to turn around and sell back into that demand that they created. That's why you see volume coming up at the highs, but they also then bring price down and accumulate at the lows. So this is how they build their position. Over time like this, they defend it by keeping a cap on it, keeping this resistance in place until they're ready to come out. That's why you see volume coming up as they break over this former resistance level and push price up into the first, what we call sign of strength. But this is where they're taking their first round of profit. It makes sense because they're hitting the former highs. There's a lot of retail holders that have been holding through this entire period that are anxious to get out of that, holding out of their loss. So that provides supply and a great opportunity for institutions to come back and backtest demand. So this backtest comes down and backtests the former resistance level, flipping it into support. That is the definition of a pivot. It pivots from former resistance into new support. That's when SOFI transitions out of this institutional buying process and into a new uptrend. The confirmation signals that we're looking for is these weekly moving averages. Are they sequentially in order? Are they all turning and sloping up, including this brand new 200 weekly exponential moving average is also sloping up? All very bullish signs. But now that SOFI has back-tested support, our role as swing traders is no longer to evaluate whether or not SOFI is going to come out of this institutional buying range, but at what point is Wall Street going to take their next round of profits? Because that's really our edge in the market, and why we produce Clarity every week is to help our members identify what is Wall Street's strategy in these trades. Because if we can align our strategy to their strategy, we're going to be okay. If we buy when they buy and sell when they sell, we're going to let them do the work and we're going to reap the profits. And so to do that, we've got to identify these levels as they execute in their plan to push prices up away from their investment. They want to protect that investment by pushing price away from it so they can begin to reap the rewards of taking that long position. As they do that, we're going to try to identify at what levels are they going to take profit. And to do that, we're going to use a tool that institutions use themselves, which is this Fibonacci retracement. This Fibonacci retracement starts at the all-time high. That's where our 1 is. Our 0 is at the all-time low. And that provides us with levels that institutions have traditionally taken profits at. that allows us to align our positions with these levels and align our expectations with these levels, because this is how professionals manage their positions. We do expect to see a sign of strength develop at all-time highs. It would make perfect sense. At that point, we might see a back test here as Wall Street takes profit and they absorb as much supply as they can. They want to reload their position after they take profit. They buy the bottom as it comes down. You can see volume coming up. We expect to see something similar here. We're going to hopefully see a back test of these upward sloping moving averages, watching this 1883 level. If it can hold this level, that then opens up these higher Fibonacci levels. That opens up the next phase of the uptrend. And we're going to be managing our positions alongside that. As Wall Street takes its profit, we will take profit. As institutions re-enter their positions off of these upward sloping moving averages, we're going to be entering into our positions as well. This isn't about calling breakouts. It's about understanding the cycle. Institutions don't chase hype. They create hype. They use that to then build trends by building positions over long periods of time that give birth to these uptrends that are a natural progression of this process. And so that's really what our job is. As traders, our job is to recognize these phases, respect the role of institutional defense and their plan, and then plan our entries and exits around their playbook, but not against it. That's why in this week's Full Clarity article, we didn't just look at SOFI alone. We analyzed the entire sector, including XLF, including ArcF, including PayPal, and Robinhood. If you haven't checked it out, you should. You want the full breakdown, all of our trades that we're considering in the institutional roadmap for these setups. There'll be a coupon up at the end of this video. That's all the time we've got for SOFI this week. We'll see you next.